We're Compound Everything, and last week we talked about Fundsmith, who is run by Terry Smith, who is considered the Warren Buffett of Britain. Mm-hmm. And we discussed 9 things that he looks for in a stock, and we thought we were going to focus on number 1 today, which is he invests in quality. And if you want to know the other 9, you can go back to that other video, part 1, and watch that. And before we get going, if you can like and subscribe to this video, that's super great because it really helps our channel. Mm-hmm. So Terry Smith is known for investing in companies that have long runways and whatnot, but one of the things he constantly says in lots of podcasts is that he likes to invest in quality.
Yes.
So let's extrapolate that 1 point, because I think the other 9 points that we discussed last video can almost be wrapped up in that one overarching point.
Right. I think it is summarized well in one of his shareholder letters. I'm going to read this quote from him. It says, "Yet it is inconceivable in our view that it is not of higher than average quality in terms of longevity, resilience, predictability, gross margins, return on operating capital, and the conversion of profits into cash. Put simply, this means that we own shares in businesses that are of higher quality than the market on a valuation about the same as the average for the market." Okay. So those are the things he looks for.
So many of his companies are very old, like decades old.
Yeah.
And that's one way he knows that they have these strong qualitative factors, because we've talked before in many videos that you look at 2 things when you're looking at a company. You look at the quantitative factors and you look at the qualitative factors, and you kind of have to marry both of them.
Yeah.
And the companies that tend to do best, that really run and bring you those returns that you want, have both qualitative factors, like excellent qualitative factors, and excellent quantitative factors.
Yeah.
And by virtue of his companies having Lindy'd, so to speak, they almost prove themselves to at least have those high qualitative factors. So what are some of the companies that would be an example of that in his portfolio?
Well, there's several, I guess. I mean, just go back to your point in terms of longevity. Longevity is one of those kind of qualitative criteria that he looks for. Resilience is another, and predictability. So he likes companies that are long-lived, predictable, and resilient. They've been through some stress and they've kind of pulled through. And so I think to that point, he says that one of his shareholder letters, he mentions that the average age of the companies that he owns was started in 1894 or something like that. Now, I think that's probably changed with some of his holdings more recently, because that's one of his earlier shareholders letters from the 2012s, 2013s or something like that. But it just speaks to that point of he's looking for companies that have withstood the test of time. They've proven their business model.
They've gone through recessions. They've gone through depressions, maybe. They've gone through maybe like some wars.
They've gone through business cycles. Yeah. And one of the things that he likes to say is the business cycle, he's like, a year of performance isn't, a calendar year of business performance isn't a very useful measure. Like, business cycles aren't measured in a year.
Right.
That's the time it takes for the earth to go around the sun, is one of the things he likes to write in each of his shareholder letters. Right. And so from that standpoint, measuring year by year performance, I guess, is important for a stock, but more measuring how it's done through various business cycles and ebbs and flows of the economy and whatnot. Right. He was looking for businesses that have done that and have withstood and are going to continue to be able to reinvest at consistently high returns, and it's going to withstand the test of time.
And it's interesting too, because he says a year a company does not make, essentially, is what he says. And we often say a quarter
a company doth not make.
Yeah,
that's right.
Right?
Yeah, just because a company has a bad quarter doesn't mean it's a bad company.
Right, and Wall Street loves to look at in quarters, and he doesn't even like to look at a company in years.
Yeah, well, he looks at years.
He looks at decades.
Yeah, he looks at long times. So he says, a calendar year, not very useful. Yeah. I guess you could look at it in 2 ways, right? So in terms of, both a good business and a bad business, Wall Street likes to hype up good businesses because they've had a good quarter. Yeah. And, there's certain companies that did really well during the pandemic that actually really just cratered. Yeah, some of them actually did well fundamentally for a time. I'm thinking for a short while. I mean, I'm thinking specifically of some of the gaming stocks.
Okay, yeah,
some of the gaming stocks or Zoom and things like that, they did really well for a short time, but that wasn't a business cycle. I'm thinking of like Zoom and Moderna and companies like that. And so they had temporary significant run-ups, and you could see their earnings were there, but they didn't withstand that test of time. How did it extrapolate over a period of a lengthy time? And then similarly, a company that's depressed, well, are they just going through a bad time? You could have maybe looked at certain oil and gas sector at that
Yeah.
point in time during the pandemic. Their earnings were terrible, but
Yeah.
as we know, that was a temporary thing. So,
Right.
how do businesses withstand the test of time? Having said that, Terry Smith has said he explicitly would not invest in the oil and gas industry. So maybe that's just a bit of an aside.
Yeah, but that did work out really well for us.
That worked out really well
Very,
for us.
very well for us, yes.
Okay, so some of the companies he owns, we digress. We went down a little bit of a rabbit trail. So what are some of the companies that he owns? They're most oftentimes, if you look at his holdings, if you go on Dataroma, it's one of our favorite websites, and you look up Terry Smith, you'll see a lot of his holdings there. Funny enough, actually, it has him listed as more than about 40 holdings, I think is what he has there. But he says he likes 20 to 30. And I think that's because he has a couple of different funds, and that may be why the discrepancy.
And we have found that in Dataroma, particularly when we were studying Francis Chu.
Yeah.
Because we were doing a lot of research by listening to different lectures that Chu had given. And all of a sudden we were saying, like, this doesn't show up on Dataroma, and that's because they only put up some funds.
Right.
But he had other funds
Yeah, different
as well.
funds, yeah,
so
listed.
You can't only use Dataroma. You do have to kind of like dig around.
Go do
for
your own
all
research.
Your diligence, yeah.
I mean, it's a great tool, but that's to get you started.
Yeah.
Anyway, so what are some of the companies that he owns? Well, he owns Microsoft. He owns Meta Platforms. And he owns a few other older companies too. At one point, he owned Kone Elevator.
Yep.
He owns Otis.
Yep.
He owns L'Oreal. That one's been around for several decades. And so these are companies that,
I'm
again,
actually wearing L'Oreal on my face right now.
well, there you go. See,
Yeah.
It's perfect. It's a perfect fit.
Yeah.
He did own Estee Lauder, but sold. And so these are companies that have been around for quite some time. They've been through a few business cycles and whatnot, and they again have withstood that qualitative test of time.
Yeah.
The reason they exited Estee Lauder was because of their China handle, I guess. So he didn't like the way they handled entry back into China, and that was the cited reason of them leaving.
Yeah.
So that really spoke to me because it tells me how closely he keeps track of the businesses they own.
Yeah.
And he understands their business models, and that makes the difference as to whether he buys or whether he sells. And one of the things we often struggle with is, when do you sell a company? And his take on that would be, you don't sell the company that's doing really well. Right. So if you have a company that's generating consistently high returns on capital and they're executing well, the answer is, when do you sell? You don't. You don't. It doesn't matter if it's gone up, twofold, threefold, tenfold. If it's still doing well, you
hold it.
Sit
you let
on
it bake.
You let it bake.
And we're not the only ones who struggle with selling. Li Lu has been questioned in a lecture I watched by him. Someone said, when do you sell? He's like, oh, well, that's the question.
Yeah.
Right? That's the hard question. Buying's the easy one. And actually, a good friend of ours who manages advisors and portfolio managers, she was saying that it's because she asked me one day, she was like, what do you find the hardest about investing your money? And I said, the hardest thing is to know when to sell a position.
Right.
And she said, it's interesting that you say that, because I recently just had a meeting with all of my advisors, and I said, what is your exit strategy? And not one of them, I think she said there was a group of 10, not one had an exit strategy for their positions.
Wow, interesting.
Yeah.
That is fascinating. So I think, according to him, exiting would be, again, qualitative or quantitative. So, and often one leads to the other. So he said, for L'Oreal as an example, he didn't like their China exit, or their China
Estee
entry.
Lauder.
For Estee Lauder. He didn't like their kind of replay into China. So that was a qualitative call. The other thing is, if the fundamentals start to deteriorate, so they're not able to consistently earn that high return on capital employed, if their maybe revenue's dropping and things like that,
now,
without good
how
explanation.
long would he allow that to go on before he pulled the plug?
That's a good question. I don't know, based on reading his letters.
Because obviously 1 quarter, again, a quarter.
That's not a company make.
Right.
Yeah.
So like at what point, like a year, 2 years? I wonder if he's ever mentioned that.
Not that I've seen.
Okay. So going back to L'Oreal, he does still hold that in his portfolio. And you have said that you were listening to an interview, or maybe you're reading something, and he loves that company. Can you tell us what makes you say that he just loves L'Oreal, and why is that such a good company to him, and how can we use that looking for other companies?
I think he likes L'Oreal because, well, a few reasons. So one, they earn consistently high margins. So that's a quantitative measure right there. They earn consistently high return on capital employed. I think he just likes them on a qualitative basis because of I guess he just sees an area that's still ripe for growth.
Right.
In my opinion.
So you had mentioned before that he compared L'Oreal to Campbell's. L'Oreal being an example of a great company and Campbell's being an example of a not so great company. So is there anything that you could share with us from that?
So what he said, he was talking about inflation and how inflation impacts different companies. And he used them as an example because they're both in, I guess, a consumables business. I mean, different, obviously. And I think, if I'm not mistaken, if I'm recalling right, he said they earn fairly consistent gross margins. But the difference was on the input costs. So he said that, people, when they talk about inflation in good companies, he says, well, they can just raise prices. He's like, well, wait a minute, it's not that easy oftentimes to just raise prices. If you're Campbell's and you are talking to Walmart and say, oh, well, guess what, Walmart, we're increasing our prices 5%. They might give you a little bit of a headache.
Especially when you're a company that has to do with what people would say is an essential. I don't know for sure, but I would guess that Walmart or Loblaws isn't going to care as much if you're increasing the price of your mascara by 30%.
Well, I mean, living in Canada, we know that the grocers have come under some pressure for raising prices and on food specifically.
Yeah.
So I mean, Campbell's. I don't think any government official really cares that the price of makeup's going up.
No, and actually, Loblaws and Pepsi got into a real battle not long ago where you couldn't even buy Doritos.
That's right.
Pepsi just pulled their Doritos off the shelf at Loblaws because Loblaws refused to do the price increase.
That's right, and they were trying to pass it on. So you're right,
like you can't just raise the prices because there's all these distributors and other people at play.
Well, I mean, if you think about it, Loblaws and Walmart and those larger retailers have people whose job it is to negotiate the best prices. So
I mean, when you go to Superstore, that's like a cheaper kind of grocery store in Canada, and you go to Walmart, you are expecting you have an expectation of price in your mind,
for sure,
right? Like if you go to Safeway, you're going to be up paying for the groceries that you're buying, right? You're just, when we go, we know we're going to pay $100 and walk out with 3 items if we're at Safeway. But if we go to Superstore, we have this idea that things are going to be cheaper, so they have this reputation to keep.
Right. Precisely. And so in a situation like Campbell's versus L'Oreal, the input costs for L'Oreal were so much cheaper than for Campbell's. Campbell's spends almost nothing on SG&A, like in terms of advertising and all that kind of thing. They have very little spend there. Right. So a lot of their costs, or the bulk of their cost, is input costs. So it would be things like the tin for the tin cans. It would be the ingredients, the tomatoes,
the manufacturing for the label.
Right. It would be the labor costs and that kind of thing. So if those go up, 5%, they have very little room. It's going to eat into their profits. Whereas somewhere like L'Oreal, where that makes up a much smaller percentage of their we'll call bottom line. Then their bottom line is going to be less affected.
Right, because and they do spend a lot on SG&A.
Yeah,
and that's not so much affected by.
Right, so, and then think of a software company. The other example he used was a software company. So if you use a software company as an example, they have very little, input costs. I mean, theirs is just human resources largely, and I mean compute power and that kind of thing.
Right.
But they don't have, so much raw material costs. So if raw material costs increase, as what happens in inflation, then the inflation effect on them, on a software company, is probably close to zero.
Yeah, like the software as a service companies don't feel that the same way.
So going back, I mean, that's one of the reasons he liked L'Oreal is because it's somewhat inflation resistant in a sense. And in this inflation environment, he used that as an example to say, this is why I like that company.
That's very interesting.
So kind of going back to answering your question in full circle.
Yeah, that's okay. So there are some metrics that he looks at. We talked about, again, these metrics just briefly in the last one. Let's see if I can just recite them off the dome here. I think they're operating margin, gross margin, interest coverage, return on capital employed, and I think I am missing one.
And the last one is cash conversion.
Oh, yeah. Now, he had numbers that he said he likes to see. And for instance, ROCE, in an interview that I listened to at one point, he said he likes it to be upwards of 27%. And I think he has numbers for the other ones too.
He does, I think where these numbers come from is actually if he compares them to the S&P 500.
Sometimes I get caught up on those numbers when I hear a lecture by someone like him,
Yeah.
or I hear Li Lu say, "Oh, you're never going to find a good company with a P under 30." I get caught up on these numbers, and I don't ever want to deviate because so and so said this. But it's a reminder, like these are not.
They're not set in stone.
Right, like they themselves.
They're not the Ten Commandments.
They're not the Ten Commandments. They themselves don't always reach these numbers.
Right.
This is just like the perfect company if they could find it. And so there is some breathing room, and there's a lot that goes into a company. And these are just, it's kind of a guide. They're guideposts.
Well, I think too, going back to what you're saying there is it being a guidepost. I think you have to take these numbers in the relative environment that you're in, right? And I think that's why he does compare it to the S&P 500 and the FTSE, because those numbers have changed over time. So if you look back in the let's say everyone's favorite ratio is the PE ratio.
Yeah.
If you look in the 1930s,
which he actually doesn't.
Which he doesn't really look at.
He says he doesn't even care about the PE ratio.
Right. Yeah.
He cares about the cash flow. And the capital employed.
Yeah, and cash flow yield.
Yes.
Is what he talks about a lot in some of his earlier shareholder letters. But if you look at the everyone's favorite ratio, which is the PE ratio. The PE ratio back in the 1930s, like there was a time in the 30s, the PE ratio of like the whole index would have been 5.
Yeah.
Right. So if you're looking for something
crazy.
with a PE of 5 or less, now like good luck. Yeah. So I think what we need to do as investors, the teaching point for me in reading Terry Smith's letters was, the benchmark changes.
Yes.
Right. So if you're comparing it to the benchmark, which is what you should probably be doing to gauge your performance.
You said he compares every company he looks at to the benchmark.
Yes.
Not just his overall portfolio.
Right. I mean, he has a certain hurdle that he looks for. It sounds like the way he does it, he has a screener. He didn't say this explicitly, but he says he is a screener. And so he'll have this investable universe of stocks, which he rules out certain ones from the get-go. Yeah. He won't invest in banks, won't invest in insurance companies, won't invest in oil and gas companies. Cyclicals, commodities, all out.
Yeah.
And so he's left with a relatively small universe of stocks, which he then runs through almost this kind of screener. So that screener would involve, again, gross margins, operating margins, return on capital employed, cash conversion, and interest coverage. Right. Yeah. Thank you. And so he's looking for certain things, in the business, on a quantitative perspective, right? And then at that point, they also have to be consistent.
Yes.
Can't just be for 1 year.
And they've had to have proven themselves.
They have to have proven themselves. So it can't just be some fly-by-night company. Yeah. We made that mistake before, actually. Seeing these companies with these beautiful metrics, but they've only been a year or two.
Right. Yeah.
And then invested in them, and they get burned, right? And so from that perspective, they haven't proven the test of time. So I think there's a lot of wisdom in that. And then comparing those to what's the current market environment like, right? And there are times where you may want to just sit on the bench because you can't find anything.
Yeah. So one thing I will say, though, is that he doesn't play the macro.
No, he does not.
We said that last time.
Yes,
and that's
he
one
does
of
not.
our 9 points. Like, he does not worry about the macro.
Well, and funny, he always remains invested.
Yes, fully.
Fully invested. He did say that, yeah.
Yeah, he remains fully invested.
Sorry.
No, it's okay. And then on X yesterday, I saw a tweet. What do you call them now?
X's?
X's.
I don't know
I'm getting used to not calling it Twitter, but now I'm like, oh, wait, a comment? A comment. I guess you just call it a comment. Okay.
Sure.
So I was on X the other day and I saw a comment, and it said that the idea that you're going to find a play in the market every week is insane. And usually, particularly for value investors or qualitative, I'm going to call Terry Smith a qualitative investor. I don't think he's a value investor.
No, I wouldn't say he even calls himself that necessarily.
Yeah, and he doesn't call himself that. But he does have a lot of attributes of a value investor, right?
Sure.
He's not super busy.
Yeah.
He lets, he buys great companies. Yeah. But anyways.
And he knows he has to pay for them.
Yeah. And so it said, the idea that you can find a good play in the market every week is just astonishing that people think that, because generally for a value investor, you're going to find maybe 2 good investments a year.
Right.
And I was like, that's true. Like, a lot of people are just looking every week for something new. And That's just not the way the market works.
No. And in fact, if you're looking to keep busy as an investor, one of the things I'm starting to appreciate more and more is if you're trying to keep busy as an investor, rather than looking in the market for new opportunities, study the ones you already own.
That's
and
true.
Whether you should be still holding them or not.
True.
You know,
because we're really trying to trim down our portfolio. Our portfolio has ballooned into way too many positions.
Exactly. And so at this point, there's a lot of stuff in there that would not meet Terry Smith's criteria.
Yeah.
And or even our own criteria as being reasonable investments at this point.
Yeah,
so
just because we've evolved and grown, and so we're actually doing a lot of rebalancing right now.
Yeah, and we've made our own mistakes and learned from them. And I think that's the point, is learn from your mistakes.
Yeah.
You probably the time is better spent learning from your past mistakes and studying the companies you already own than looking for new ones.
Yes.
Most of the time.
Sure.
The numbers that Fundsmith posted for 2022 for the 5 metrics we discussed: ROCE, gross margin, operating margin, cash conversion, interest cover, for 2022 is return on capital employed of 32%, gross margin of 64%, operating margin 28%, cash conversion of 88%, and interest cover of 20 times. So those are the average numbers for the companies that Fundsmith owns. And so they handily beat the S&P and the FTSE indexes.
They really did.
They really did.
Yeah,
so,
and that's why the one company, as we talked about, L'Oreal, might not be exactly that. And there are obviously other companies that are much more than that.
For sure.
Yeah.
And I think the philosophy of Fundsmith is, if you buy high quality companies that have withstood the test of time, that perform on average better than the indexes for a price that's around what you would get the index for, it only stands to reason that you would beat the index.
Right. Yeah, exactly. And that's what we want to do.
And he has. He's compounded money at just over 15% annually since inception in 2010.
Yeah, that's crazy.
That is crazy. So what is the summary? What would Terry Smith say if he was here? What would be the summary of Fundsmith's investing philosophy?
So in 3 points, Fundsmith would Terry Smith
what would Terry say if he was sitting right here?
10 seconds to tell me what you do.
Yeah.
He would say, buy good companies, don't overpay, do nothing.
Brilliant.
Yeah. So that wraps up our discussion for today. If you could like and subscribe again to our channel, that would really help.
Helps us out.
Yeah, and we will see you next week.